In the first 3 episodes, we laid out the bubble logic behind AI stocks, and through 2 companies, we explored defensive strategies against the risk of a burst. Eaton sits at the power gateway of AI capital expenditure. Rockwell Automation stands at the control layer of factory automation. What their products and services share is a common thread. They pull AI back from the realm of technological narrative into the physical world for validation. But both power infrastructure and industrial automation face the same risk: the capital expenditure cycle. When tech companies cut data center budgets, when manufacturing recovery is interrupted by high interest rates, when the market runs out of patience with AI, in all these scenarios, Eaton and Rockwell's orders would suffer as well. So this episode, we shift gears. We're looking for an asset class whose profitability doesn't depend on AI investment returns, doesn't depend on factories buying new equipment, and doesn't depend on expectations of strong economic growth. It relies on a set of older, more stable variables: risk, probability, contracts, and compound interest. That company is Chubb. Chubb is one of the world's largest property and casualty insurance groups, with a market cap exceeding $130 billion. Its business is classic. Businesses and individuals transfer risks, property, liability, cyber attacks, accidents, by paying premiums to Chubb. Chubb then decides whether to underwrite the risk and at what price, based on its assessment of future claim probabilities and costs. In the first quarter of 2026, Chubb's core operating income reached $2.69 billion, up more than 80% year over year. Core operating earnings per share came in at $6.82, beating the consensus estimate of $6.48. The P&C combined ratio improved dramatically to 84%, compared with 95.7% in the same quarter last year. Excluding catastrophe losses, the current accident year combined ratio fell further to 82.1%. For every $100 in premiums collected, Chubb retains roughly $16 in underwriting profit after paying claims and expenses. And on top of that, investment income is added. For the full year 2025, Chubb generated net income of approximately $10.3 billion and core operating income of roughly $10 billion. This was not achieved through asset sales or accounting adjustments, but through 2 engines running simultaneously: underwriting and investment. To understand Chubb's value, we first need to understand the insurance business model. The real profit structure of an insurance company has 2 layers. The first layer is underwriting profit, premiums collected minus claims paid and expenses incurred. The second layer is investment income, returns generated from investing premiums during the period between collection and claim payment. The relationship between these 2 layers determines an insurer's quality. A superior insurer generates profits from underwriting itself, while its float, the funds held between premium collection and claim settlement, produces additional investment income. The combination of both creates compounding returns. Chubb is exactly that kind of company. From 2021 to 2025, its average combined ratio was approximately 87.1%. In the first quarter of 2026, it dropped to 84%. That means Chubb consistently creates profits from underwriting rather than using investment income to subsidize underwriting losses. This is a form of discipline, the discipline to remain level-headed even when the industry is at its most exuberant. Chubb's moat comes from a set of assets that are not easily replicated. Over half a century of claims data, a globally distributed risk engineering team, consistently maintain ratings of AM, Best A++, Superior, S&P AA, Fitch AA, and Moody's AA2, and decades of accumulated experience in complex risk pricing. In the commercial and high net worth personal insurance space, clients don't just compare prices when choosing an insurer. They care more about claim settlement speed, contract terms, global service capabilities, and financial strength. For a multinational corporation or a high net worth family, whether the insurer can truly pay out after a disaster matters far more than a few percentage points of premium savings. As of the end of March 2026, Chubb had total assets of approximately $275.5 billion, shareholders' equity of roughly $73.8 billion, and invested assets of about $170.2 billion, consisting primarily of investment-grade fixed-income securities. The significance of these numbers is this: while the entire market relies on the AI narrative to support valuations, Chubb's profit sources are almost entirely disconnected from technology capital spending. That does not mean Chubb is without risk. In 2026, signs have already emerged of softening reinsurance prices and increasing market capacity. If the industry moves into price competition, Chubb faces a choice: hold margins and accept slower premium growth, or chase scale and let future reserves bear the cost. The real risk is not falling premiums, it's relaxing underwriting discipline in pursuit of growth. Catastrophe risk is equally real. Climate risk, concentrated urban assets, and rising reconstruction costs mean even moderate storms, wildfires, and convective weather events can generate substantial losses. Social inflation, jury verdicts and litigation funding growing faster than the general CPI, is driving up the long-term cost of liability insurance. The premiums Chubb collects today may need to cover claims years down the road. If long-term costs are underestimated, current profits will be eroded by future reserve strengthening. Chubb's strong performance in the first quarter of 2026 was partly attributable to low catastrophe losses. If a major disaster strikes in the second half of the year, quarterly profits will show visible volatility. Chubb is an excellent risk manager, but it cannot eliminate tail risk. As of July 13, 2026, Chubb closed at $354.74, less than 3% below its 52-week high of $365.29. Based on roughly $10 billion in core operating earnings for 2025, the current price implies about 14 times core operating earnings. Using shareholders' equity of approximately $73.8 billion at the end of March 2026, book value is estimated at roughly $186 per share, putting the current price at about 1.9 times book value. A 1.9 times book multiple is not expensive for an insurance group with an A++ rating and a long-term combined ratio below 90%, but neither is it cheap. The market has already priced in a considerable premium for Chubb's underwriting quality, credit ratings, and book value compounding. If the combined ratio climbs back from 84% to above 90%, if insurance pricing continues to soften, if major catastrophes recur, the market could simultaneously lower earnings expectations and the price-to-book multiple. 1.9 times could become 1.6 times, corresponding to roughly $298 per share. Even if the company's fundamentals remain intact, the stock could suffer a drawdown of more than 15%. Defensive assets trading near all-time highs face valuation risk too. Chubb's role in a portfolio is not a cash substitute. Catastrophes can erode quarterly profits, insurance cycles can suppress growth, and insurance stocks can be sold off alongside the broader market during downturns. Nor is it a high-growth stock. The most likely scenario over the next 12 to 24 months is this: mid-single-digit premium growth, a modest rise in the combined ratio from its exceptionally low level, investment income remaining strong, the stock oscillating at elevated levels, and returns coming primarily from earnings growth and book value accumulation. Chubb offers something neither Eaton nor Rockwell can provide: a profit stream largely uncorrelated with AI market volatility. Even if tech companies slash data center budgets, businesses still need liability coverage, wealthy families still need to protect their assets, and multinationals still need property and cyber insurance. An economic slowdown may dampen premium growth, but it does not make risk disappear. With the three swords of double bubble, AI ROI concerns, and market breadth hanging overhead, the truly meaningful portfolio adjustment is to add a fundamentally different profit-generating mechanism. So here's the conclusion. Chubb is the closest thing among these four companies to a defensive core holding. A reasonable entry approach is to watch for stabilization signals around $345 to $350 and build a base position after earnings confirm that underwriting and investment income remain strong. If the price retreats to $330 to $338 without a fundamental deterioration, that would offer improved margin of safety. After establishing a position, the key metric to track is the combined ratio. As long as it stays consistently below 90%, investment income remains solid, and reserves show no signs of deterioration, Chubb can continue to compound book value. It won't make anyone rich overnight, but it can ensure that when the AI narrative fades, your portfolio still has an anchor that generates real cash flow. AI companies make money by betting on future possibilities. Insurance companies make money by underwriting those very possibilities. That's an interesting combination. In an increasingly uncertain market, Chubb's stock deserves a fresh view and consideration.